Yeah, just some perspective. 2 or 3 years ago, the dollar was 115, DXY, the index. It fell to 96 and change, I think, is where we bottomed out, week or two ago. And so we're getting counter trend trade here where it's moved, back up over 100. It had gotten so that everybody who didn't see the fallen dollar coming, I was calling, and I still am calling for 82 on the dollar index. And I was told I was crazy to even be looking for it to go down. People at 107, 108, 109, 6-9 months ago were saying it's going up. And it had a pretty sharp decline from there down to 96. So it's only natural that it's got to correct because everybody's piled on the short side now, that it's going to have a short covering rally and counter trend move. I don't know how far it goes from here. I wouldn't expect a lot more, but it can always surprise you and have a little more extension than you expect. And then I think it rolls back over and we'll see 90 probably at some point in the next 6 months, and then down from there. And so my view is that the dollar is still in a downtrend. It's just in a counter trend rally at this point. As you say, the offset to that are all these other currencies. And I think you are seeing strength in the yen, although it corrected, started strong and then corrected. But rates are going up in Japan. There's no doubt about that. Whereas I think rates are coming down here. Rates are already come down elsewhere. So we have probably the biggest move in rates coming down over the balance of this year relative to rates coming down anywhere else. In other words, we'll move more down to the downside. That will help put pressure on the dollar. It's all relative. It's where you are today. It's not absolute rates. It's where you are today, where you're going. And I think rates here are going to come down. Yeah, it's not just getting started, but we are we're in a super cycle. I define a super cycle as that period between the last depression and the next one. I think the depression was obviously the 1930s. The next one is the 2030s. Not 2030, but the 2030s, probably 2034 or 5, maybe 2033, but not before that, probably. So what happens in a super cycle is kind of what I was describing before. The cycles get steeper as you go. And now we're in certainly the last decade, maybe the last 7 or 8 years of a super cycle. And so things are getting far more volatile, far more violent. There's far more excesses in the system, and it requires far more in terms of policy response. And that's why, people take to task Fed chairman, the last, Janet Yellen before her, Bernanke, and what Bernanke did in response to the Great Recession and the huge financial crisis, biggest financial crisis we had to date in history. He had to do some of what he did to get us out of it. Yes, in hindsight, probably stayed on the zero interest rate policy for too long. And led to the inflation in 2022, et cetera. Interestingly, all of that is what feeds into the bust, because you've now got a Fed who is fighting that last war. They don't, they got beat up pretty badly in 2022 for not foreseeing the inflation that we got. They thought it was transitory, and so they kept their policy pretty much intact, and then had to scramble to catch up to it. Now, some of that was driven by oil, spiking during the invasion of Ukraine by Russia. We went from 85 to 130 on oil overnight. So some of that was, obviously investors and market traders are not patient people. So when something happens right away, they want to, play the blame game. They want to extrapolate things out. And so they decided it wasn't transitory, that, the Fed was wrong about that and they should have anticipated it. So now you've got Powell and the Fed who are fighting. They don't want to make that mistake again. They take that criticism to heart and they go, this time we gotta take seriously any uptick in inflation. We got to make sure we've wound out inflation before we go the other way. So while some people think he's being political, and I can't say he isn't to some extent, it certainly doesn't help when, whoever you are, if somebody calls you a loser, you're probably going to take a little bit of that personally as much as you try not to. So, so I'm sure there's some animosity there, and some I have no way of knowing whether there's any of that is in his policy. My gut is that most of what he's doing, because it's backed by most of Wall Street and it's backed by most of his committee. Yeah, I can't say deeper than 80%. That's pretty. That's pretty. I don't have a crystal ball to be able to know whether it'll be something larger than that or something smaller than that. But 80 is kind of as a pretty severe, once in 90-year type of crash. So I'm not looking for AI to make it bigger than that, but I think AI will certainly contribute to that. And you're right. I mean, there's an awful lot of speculation and valuation being driven to the sky on some pretty rosy expectations. And a lot of those expectations obviously won't play out in the short run. AI is certainly here to stay, and AI will contribute to whatever the next cycle looks like, hopefully positively. But my big thesis is, as I say, the macro trumps all of that, and the macro is this this huge leverage that takes us down sharply and leads to a massive response, both fiscally and monetarily, beyond anything we could ever have seen, we've ever seen before, and could ever imagine. I'm using, just as a seat of pants number, say 20 trillion out of the Fed in QE, new QE, to that will take to pull us out of the tailspin, and proportionally similar from all the central banks. We did we were up to 9 trillion. We did from 3.7 to 9 trillion in the 2020 response. And prior to that, in the 2008-9 response, we went from 875 billion to 3.7 trillion in over a course of several years. So that to say that we're going to go from, we're basically 7 trillion now, I think, to go from there to 30 trillion, let's say, in response to this downturn, it shows you how much further beyond. And again, I could be wrong, but that's kind of what I see building up. And those kind of numbers, we use trillions, like we used to use billions, like we used to use millions, but those are huge numbers that we have never, ever seen before. They blow away anything in terms of proportionally anything we've ever seen. So what it means is that's the huge story. AI will be a sideshow to that, although AI will play a role next cycle. That macro, that massive and that massive money will be accompanied by maybe not as big as that, but a pretty massive fiscal response. That means debt's going to go even higher next cycle, as we come out of the bust. So you could be, we're at 330 now, we could be at 450 or 5 by the end of the decade. 500, from 330 to 500 trillion in debt. I mean, those are numbers we throw around, but they're mind-boggling. They're beyond anything that can really comprehend what that means. So it's hard to see where AI can compete with money of that magnitude or fiscal spending of that magnitude. But AI, I think, will be a productivity enhancer. So that's a good offset to what I think this massive money is going to lead to with a lag. It's not going to happen in 80,